A little bit, why to listen to us here today. The marketing, this was important to me. I made sure that we sent out, the reason you guys registered. One, I'm asking you to spend 2 hours with us. I know that's a little longer than normal, but, most of you are spending 2+ hours a day on your trading. All of us can learn something. All of us can do better in our trading, me included. I mean, I'm always looking to learn things because I do not trade with 100% success. I know I never will. So any incremental improvement I can find in my trading is always well worth the time. So I wanted to make sure that we've got really good content in here, which we do. Certainly I'm going to tell you about the Premier Trader University and the opportunity there, but there's a lot of great education in here. And then we also want to reward you for spending the time with us, and we'll show you how to get kind of the prize or the reward, which is really this training on a USB thumb drive that we'll send you. So we'll do that at the very end, kind of as the reward for sticking with us during the training. So what we're going to cover today, the 3 main topics are going to be, number 1, which I'll present, the hottest and potentially most lucrative markets this year and beyond. Mike Rixey will come in and present to you on the lost and forgotten opportunities in the markets that will really make you want to take a second look. And I actually think this is kind of the thing that's going to explode on us. So, and it used to be the hot thing to trade, so it's really interesting. And number 3, I'll come back on and I'm going to talk about really growing and scaling the trading business, really I think faster than any business opportunity on the planet. We'll talk about an introduction to the Premier Trader University and how to get your free USB flash drive and all the resources, plus a Q&A as well. So we already mentioned the free flash drive. Ooh, that's really nice. It's really cool looking. So you guys will get this as our way of saying thanks for listening to us, learning what we have to share with you today. We've also put some really cool stuff on it so you can use it as well as learn from it. We've got resources, tutorials, education, to really take what we're talking about today and move it further. Just stay to the end of the presentation. That's the only catch that you've got, and I'll go ahead and show you how you can get that. And we'll give you the special link to that. 1 per household, blah, blah, blah. We'll talk all about that later, but no big deal. All right, most of you guys know who we are. I'm in the top left. Brian, you heard from the beginning, top right. You've got Mike Rixey down in the bottom left. This is like the Brady Bunch shot here. And there's this is the whole team that helps us support the Premier Trader University. We have other people on the team as well. My apologies to them if their face isn't on here, but this is the main team that's supporting the PTU education. All right, so let's jump right in and talk about the hottest and potentially most lucrative markets in 2012 and beyond. And it really may not be what you think, especially based upon the survey answers that I just saw. Now, for those of you new to trading or maybe wanting to get back into it or maybe just needing a little motivation, maybe things haven't gone that great, why should you pursue trading? Remind yourself of these things. The opportunity really is limitless. There are billions of shares, contracts, pairs traded daily, every single day, day in and day out. You really can get started with a minimal of capital, more than what you typically see out there in the marketing fluff world. I mean, I'm going to be realistic with startup capital when we get to that part. Nevertheless, compared to any other business out there, it's pretty amazing what you can actually start a real credible growing business with. You can very much control your leverage. You guys, 40% of you understood that risk was really critical, controlling the risk and reward. You know what? No employees, limited overhead. I mean, that's all great stuff because trading doesn't, guarantee you the fixed same amount every single day. What business does? So it's really nice that you can control your overhead. In the third topic we covered today, we're going to talk a lot about the P&L and overhead, and you're going to see why it's so nice not to have the employee line. You definitely can decide your own schedule, your own hours. There's just so many different opportunities available to you. If you want to be a part-timer, a full-timer, it's great flexibility. And if you do it right, this can really be your profession, your business. If you have other passions, this can be a great complement to those other passions. So I think it really comes down to choosing between day trading or swing trading. Most of you, when we ask that question, are doing day or swing. Very few of you identified yourselves as a position trader. One, because position trader has been so damaged, right? Over the last decade, it's been pretty much a failure. It just doesn't work. So you have to be more of an active trader these days. I see no change upcoming in that way. It's very hard to buy and hold anything. So you've got lots of really cool opportunities in futures. I think most of you are familiar with what futures are, but basically you're buying a contract. They move based upon how the stock indexes move. When the indexes go up, they go up. When they go down, they go down. Energy, crude oil, natural gas, metals is things like gold and silver, copper. Agricultural, think wheat, soybeans, corn. Interest rate, pretty straightforward, 10-year notes, 5-year notes. My Forex people, you guys know Forex pairs, the euro US dollar, the pound US dollar, the Aussie US dollar, the pound yen, etc. And then stock ETFs and options, you've got a gazillion choices, but as it turns out, there's really a nice small subset of the best choices overall. But the first thing you got to do is you got to determine a little bit, hey, do I want to be a day trader or do I want to be a swing trader? So let's talk a little bit about what is working best right now. And I feel if you want to day trade, you should think futures, not Forex. And I know that might be contrary to what some or a lot of you are doing or thinking, but you have to understand that we work with thousands of traders around the world. I get to see into all kinds of people's accounts, their experiences, their successes, their failures, and really what we're seeing, the best opportunities if you want to choose day trading is going to come from futures and not from Forex. I believe if you want to swing trade, however, absolutely Forex, great opportunities, and stock ETFs and options, which you're going to find out about from Mike here in a little bit, why that is such a brilliant opportunity for all of you overall. So let's talk a little bit about day trading and the futures. Why do I think Forex day trading is flawed? I mean, it's kind of strange to say that because I know it's the easiest thing for us to say that, oh, it's amazing, it's get rich quick. You know, that's what a lot of people want to hear. I realize 60% of you are trading Forex. But in my 17 years in the business, I can tell you honestly, point blank, I know a lot more people profiting day trading futures than I know strictly just day trading Forex. Okay, that's probably the biggest statement I can tell you. It's just the reality of all of our experiences here at NetPicks and literally working with more people than you can believe. Okay, why is that the case? I mean, you got to scratch your head because we've all been sold that, you know, Forex is the most amazing thing. So I've got some of the reasons that I've identified that you may be experiencing that I think is really impacting your results. I think on the charts, I think Forex looks amazing. The problem is we just don't see a lot of people getting the chart results in their accounts. And if you've traded Forex and you try to day trade, some of the reasons on the screen you're probably very familiar with, maybe kind of unhappily so. Number one, you've got lack of centralized trading. There's no central clearing firm. I hate that. I now have to trust my broker to set the market, set the prices, and how many times at NetPicks do we get complaints from people, not to us, but them saying, geez, I never saw that setup. I never got filled at that target. I got stopped out. The other guy didn't, because there is no one place you can look which has all the executions. You are literally having to trust your broker for everything. Do you really want to trust your broker for everything? You know what? I mean, they do a job for us, but I certainly don't. There's been a lot of things in the news lately that certainly are going to make you think more than once or twice over that. The commissions are way too high. They always say there's no commissions, but there is commissions, and we're going to talk about why this is a problem. The fixed spreads are really a problem when it comes to day trading. First of all, you can't trade most of the currency pairs out there because the spreads are too wide. There's a few markets where they're not, but don't think for a minute the spreads you're seeing are really, truly exactly where the market's at. They are manipulated, they are moved, and they're a little bit off the market. The other thing a lot of people have is just trying to execute. I call it the deep freeze. Your platform freezes, the market freezes, news comes out. Geez, you can never execute the darn thing. I had a trade today in futures that I got in and out in 7 seconds in a fast-moving market. I'm going to tell you that's just not going to happen in Forex. Something's going to freeze. Something's not going to execute. They're going to arbitrarily widen the spreads. You all know this. They tell you, oh, it's 1 to 2 pips in most market conditions. Oh, except for the good ones where there's easy profits. Then the spread's 12 pips, 20 pips, or you can't even execute. And you cannot day trade without liquidity. If your liquidity is not assured, you should not be day trading that markets. And you'd be surprised, Forex day trading, I find, is actually a heck of a lot slower than futures. I can get in and done on futures much quicker on most days than I can ever do it on Forex. Now, a lot of people then think, well, that's all well and good, but I don't think there's enough liquidity in future because I'm always hearing this $2 trillion a day changes hands in Forex. $3 trillion a day, depending upon where you look. Well, I'm going to tell you that the stats are pretty darn impressive in the little old futures market too. S&P E-mini, $180 billion changes hands each day in contract value per day, just based upon an average day. Crude oil, $53 billion. Gold, $26 billion. Even corn, $1.5 billion. So there are big-time dollar amounts trading here. Liquidity will never be an issue. I mean, look at those daily volumes. We only need to trade one, or maybe two if you want to double your business, or three if you want to triple it. So if there's 2.6 million contracts being traded a day, yeah, there's enough liquidity. I think you would all agree with that. Now, another thing that comes up is people think, oh, Forex has got 50 to 1 leverage, 100 to 1, 200 to 1 back in the good old days. Number one, if you use 50 to 1 or 100 to 1 or 200 to 1, it's turned into gambling, and you will wipe out your account multiple times, and you're playing a game. This isn't about playing a game. This is about running a business. But I'm here to tell you there still is tremendous leverage in the futures markets. 10 to 1, literally up to 90 to 1. You can see here on the full margin column what a broker typically requires that you have in your account to trade one of these contracts. And this is not day trading margin. Day trading margin might be a quarter of what you see, but I'm not a believer in that at all. We'll talk about that later. But even at a full, overnight maintenance margin, you can see how much dollar amounts you really control. Pretty impressive. The margins are really good. You don't need to use anywhere near this much leverage. So I'm here to tell you again, don't feel that futures doesn't provide the leverage you need. In addition, futures trading is never a gamble. Now, in fairness, I'm going to say if you use Premier Trader University, and we do have Forex day trading plans, they always are not entering the market as a gamble. But sometimes, again, people think, well, I'm not sure. It still feels like a gamble to me. I'm trading these contracts on future pricing. You can see here, Russell E-mini, I knew exactly where I was getting in, and always I knew exactly where I was going to get out if the trade did not go my way. This is never a gamble when we trade the way we do at PTU. There's always structure. I talk about this a lot. It's really important to know, right? A bunch of you identified that entry is important, I think 18%, and 17% said, you know what, the exit is important. 1 out of 3, besides risk, said that those are critical. So almost 80% between risk, entry, and exit. Well, on PTU, anything that we do, we've always got the risk taken care of, we've got the entry taken care of, we've got the targets taken care of. That is really critical when you trade. This is definitely something you can do, and you know what, there's plenty of leverage. This is a $590 move in less than a half an hour. You don't need a gazillion dollars to control a contract of crude oil. I already showed you in just a couple slides ago that it doesn't take that much, right? Even on full maintenance, $6,800. I mean, that's almost a 10% move in 30 minutes based upon this margin. Now, I'm going to tell you later on that I'm going to ask you to have more margin than that. But still, it's pretty neat to see that anything that you thought about leverage or liquidity goes away. Costs are great. They're kept to a minimum. In the Russell E-mini, you may pay $5 for commissions. You may have no slippage. You may have maybe a tick at most. So that works out to be anywhere from $5 to $15 in cost. Well, if you're going for an average target of $400, let's say in a particular trade plan, that's only 1.2 to 3.7%, of that contract value. It's quite small. It's a small part overall. S&P E-mini, just as compelling. Crude oil futures, just as compelling. Gold futures, same story. The problem I run into in Forex are these fixed spreads, maybe 2 or 3 pips. A good target in Forex on a day trade could be 20 pips. That's 10 to 15% of the target, and that's assuming that that spread and where the broker is trading the market for you at that time is really realistic compared to the actual bank prices. It's probably actually not. So you can see that costs are minimal, controllable, and a very small percentage. That's important because, again, it may look great on the chart, but if you have all kinds of problems executing and getting the results in your account, well, then you don't have those results, right? Now you have so many great choices. Again, I've got people in here from Australia, from New Zealand, from Asia, from the UK, from the US, Canada, Mexico. You've got choices based upon anywhere you're located in the world. You have leverage choices, account sizes, volatility, day or night, stock futures, energy, metals, agriculture, yes, even foreign currency. Thankfully, centralized pricing for the euro you can trade. So no longer do you have to trust your individual broker. You actually have real exchange-based trading in the euro, the pound, the Aussie, the Canadian, etc., and interest rate futures as well. U.S. market hours, European market hours, so this is a global opportunity. And we've made sure with the PTU that we have trade plans in every single category because we know some of you can trade U.S. hours, some of you can trade European hours, and so on. Not everybody can do the same things. We all have very different account sizes, so we have to have flexibility. Now, I always say if you can just get 10 to 25% of the daily range, use that as your typical target. Really, in any system, this is very achievable. So, if the range in the S&P Mini is about $1,000 based upon current 21 points a day, 10% is $100 up to $250. If you're familiar with the way that the S&P works at $50 per point, that's 2 to 5 points. That is going to be the heart and soul of what a day trader is going to go for on that market. I mean, think about crude oil. If I'm telling you it's $2,200, well, 10% is $220. That's about 22 cents in crude oil. If you've traded crude oil, you know that's a really achievable number multiple times per day. Even 25%, if it's $500, 50 cents, very achievable. We have a trade plan right now that's going for about 56 to 58 cents on an individual day trade. That's all you need per contract. We can scale, which we'll talk about later on, with more contracts. I don't have to get, $1,000 on my move. People get, in a way, a little greedy when they day trade. So think 10 to 25% of the daily range. In addition, this is not a marathon. This is not a sprint. I'm here to tell you that the more time you spend in the markets trading, the less money you are going to make. I know that's contrary to what a lot of people think. It was contrary to what I thought. I used to think if I would just trade 7-8 hours a day, I would run the math, I'd run the numbers, I'd run the spreadsheets. That's where all the money was. And anytime I went and tried to do that real time, I did terrible. The reverse is also true. A lot of people think that they can scalp their way to riches. Go for 1 tick, 2 ticks. I'm here to tell you the costs are too high. You will make mistakes, the commissions, the slippage, the noise, the speed. It just rarely works. There are certainly systems out there that people on Wall Street have spent millions and millions of dollars developing that can scalp. Different story. We're not all in that situation, right? We're off the floor, at home, at our office trying to trade. Don't turn this into a marathon. Don't turn this into a sprint. Look for those trades that take the 10 to 25% of the daily trading range. You are going to be in perfect position if you do just that, and actually smarter than most traders heading into it. And I'm going to talk a little bit about how you do that in a moment using something called the average true range. Now, is there a secret formula to trading? Yes, there actually is, but it's typically not what people want. People typically want the thing where it's some, crazy mathematical thing, and you hear these stupid stories that you get on the internet or in your email about some old man who taught somebody, his dying wish was to teach this young man his system, and he became rich. I can't tell you how many times I've heard the same stories. But it's really, truly this formula. You have to have a trading system that always puts the odds in your favor. It doesn't mean it's going to be successful every time, but the odds are in your favor. You also need to have great training to execute upon that system, because if we just gave you a system, you will fail at it. It's just the way that it works. You have to know a lot about all the nuances that go into trading. You also have to have starting capital so you can afford your chosen market. Again, we're starting to get into that risk side a little bit. A lot of people won't even know it. I've got people on listening right now who probably failed in their trading and actually would have succeeded because you probably traded a decent system maybe in the past, but you didn't handle the risk right. You didn't handle the starting markets right. And I think you only need 1 to 2 hours to trade. That's all you need per day. That's it. And you know what? A lot of days can be less. I had a 7-second trade today. That's kind of crazy. That's not the expectation every day. But it can happen. I mean, it's not unusual for me to be done in a market in 15 minutes, 20 minutes, 30 minutes, but I have to be prepared to go the distance because not every day is that rewarding or that quick. And you have to have discipline, patience, and tools of the trade. That is the Holy Grail formula. These are the things that will make up a successful trader, and honestly, nothing else out there will. And that's always the focus with PTU. We've kind of realized it can't just be system. We've got to have all the training elements in there as well to ensure success. Now, what do you need to start trading futures on a day trade basis? I tell people $5,000 or more. I know your broker will probably tell you $1,000 or more. And you know what? I can't force anybody to take our recommendations on starting capital, but this is really where you typically should start because the broker, they're in business, and it's fine. I have no problem with this. To get you in, to get you started, to get you trading. It's not really their concern if you do things right or wrong. They'd like you to stay around, and that's how they make commissions over time. But they realize the reality is the more aggressive they can be on leverage, the more likely you're going to come in, and they're going to be able to attract a lot of the biz opportunity people and the get-rich-quick crowd. There's a lot more of those, but you guys are not that. You're going to be smart about your trading. This also enables you to use max risk 2 to 3%, and I'd like to get that number lower for all of you over time. As your account grows, you need to be under 1%. But I realize in the beginning that's not practical for a lot of people. But even at $5,000, we can find markets that we can trade with 2% risk and certainly up to 3% risk on a trade. And then, like I mentioned, we want to push that lower over time. Here's an example of a Dow E-mini trade on the PTU. Again, I want to stress I knew exactly where I was getting in. I knew already on this trade plan that my average loss was going to be $138. That's the average. Some are less, some are a little bit more. So I immediately know, hey, I can trade this on a $5,000 account, keep that risk under 3%, even on the averages, and have safety. The third topic we're going to be talking about a little bit later, you're going to want to stay around for because I'm going to show you just how dramatically losing trades factors into determining what you should be responsibly trading. Now, swing trading is huge. I think there's a great opportunity in swing trading. I think Forex is a perfect choice for swing traders, and stock and options are amazing. You're going to learn about that in just a few moments from Mike. You just need 15 to 30 minutes a day. You don't need to monitor every tick. It can be a heck of a lot less stressful. You can definitely trade from anywhere in the world. You've got a few cautions. You're going to have overnight exposure that you don't have with day trading. Your trades are going to be on over a lot longer stretch of time, and you need to have some patience. You can look at a chart and go, oh, I could do that. But trust me, sometimes when you're waiting a day or 2 or 3 days for a trade, your patience is going to be tested. But there's a lot of things that make swing trading easier. 24 hours a day can be completely manageable through some of the things that we teach. One is called snapshot trading. I don't want somebody staring at the screen 24 hours a day. I want you to spend a few minutes here and there, take a snapshot, do your action, move on. If you missed an entry, we have something called getting in sync. So many opportunities to get in sync with trades that have already executed. And trade zones, I'm here to tell you a good part of the trading day and night is worthless. It's garbage. I want you to focus on the times of day or night that provide the best trading opportunities. So we've made sure with our PTU Forex swing trade plans that we incorporate all of these, because what I don't want is somebody to have to sit here and stare at a 4-hour chart, and here's a 4-hour chart of the Euro Aussie, and have to be around for every single setup day in and day out. That's just not a way to live. I have the little tropical paradise there because I want to remind all of you, you need to focus that way. You do not, want to trade in a way that you couldn't be, sitting out there by the pool. You honestly can in this, but you could not if you were day trading. That's the beauty of swing trading. A day trader is not going to probably sit at the pool. It's stereotypical. You've seen the image in marketing. You're going to be at your desk. You're going to be staring at the screen. A swing trader does not have to do that. These trades take several days. Most of the trades here that you're looking at on the screen took 1 to 3 days. Plenty of time to act, to make changes, to manage the trades. Now, let's go through a few more secrets I want to give you guys on the educational side. If I can tell you one thing, if you want to day trade, don't day trade with time interval bars. 1 minute, 2 minute, 3 minute, 5 minute, 15 minute. For the most part, they're way too slow to respond to fast markets. They're way too fast to plot in slow markets. I'm a huge believer in what we teach, which are called range bars or tick bars. There's things called Renko bars, anything to get off of the stereotypical time intervals. However, you got to be careful, because if you use range bars, your results will fail over time if you use what I call frozen range bars. I had this problem about a year ago when I was using range bars. I was killing it. Actually, August of last year at this time. And somewhere in September, my same systems, my same results started to really fall off a cliff. And the reason was I was too locked in on the size of my range bars. And I want to show you something why the reason is. So look at the first line on the S&P Mini. In January, it was averaging about 20 points a day. In April, about 15 points a day. In July, back to 21. Well, look at the Dow, 190 points a day in January, almost cut in half. Just a few months later, 118, and here we are in July. We're almost back to where we were in January. But if you took 25% of the range, look at the variance from 29 points to 48 points. Well, what if back in January I told you my target was 48 points? How do you think that would have worked in April? Pretty crappy. Because now I suddenly almost need to go 50% of the range to get my target. I can tell you as a day trader, that ain't going to work. It's going to work on a few days that run, but most days do not run. Most days go up and down. So this is what happened to me. I was trading like January conditions and using targets based on January conditions, and suddenly I was in a month like April where the ranges went down a lot and my trades were working and never actually reaching target. That's no fun. So you have to be able to be dynamic about what you trade. And the solution really is we take percentages of the average true range. That's what we teach people in the PTU, and this was the aha moment. This is what turned it all around for me personally, and this is what made range bars just so incredibly dynamic, the way that market conditions change. And if you think the changes here are big, this year they're nothing. If I went back a few years, I could show you times that the Dow was twice what it is today and times that it was 25% of what it is today. So that's why this is so critical. Another huge thing is trade zones and dead zones. I'm going to give you these on the stock indexes in the U.S., the energy futures, the metal futures, and the European stock futures. These times here are all New York. These times, I'm guaranteeing you, has 80% plus of the profit opportunities. If you just focused on these times, you'd be in, you'd be set, and this is the way we develop our trade plans, okay? You do not need to trade the whole day. You do not need to trade the overnight. You don't need to trade the pre-opening. Look at these plans, 90 minutes, 90 minutes. Yeah, one stretches for 3 hours. Okay, granted, sometimes you have to, but I'm giving you the entire window of what I think could or should be traded. Okay, so that's it. The rest of the time I consider the dead zone. Yes, there's some afternoon trading that can work. We have some trade plans that work in the afternoon, but I'm going to be honest, they're not as good as the morning plans. They're not as good as the ones you see here. They're decent, but they're not as good. This is one of the keys, focusing on these specific times. Another specific key is we teach power of quitting. And I did say quitting. Quitting is always this negative thing. We teach people in most of our plans to do something we call POQ1, which means one winning trade plus positive results, you quit. Stop right there, walk away. Now, if the first trade loses and the second trade wins, I don't quit yet unless I'm positive. But I absolutely do quit in the circuit breaker of time. So we have a few different things working here. And look at these results on a few plans over a little stretch of time. The Dow Mini on POQ1 made $4,800, averaging $41 per trade per contract. When I pushed it and tried to get 2 winners, my profits got cut in half. The marathon doesn't work, right? Crude oil, what happened? Well, my profits didn't go down very much, but look at my average winner. It got cut by 50%, but I put in twice the amount of time, by the way, to do POQ2. DAX futures, it went up. My profits went up. However, my average trade winner went down, and I just doubled my time. Is it worth it? All that extra stress, time, cost, slippage, commissions? Hell no. Silver, is it worth the extra $2,000? You know what? I could trade 2 contracts and double POQ1 and spend half the time trading 1 contract, POQ2. This is something for some of you, if you're new to us, this is going to make a huge difference in your trading. You also need to be really realistic in your expectations and your drawdowns. This is from a CTA report, professional traders. They're trading huge accounts. We really have a huge advantage as retail traders. Trust me, we don't have to trade $100 million at a shot. I don't have to hold the futures overnight. But I want to show you, even huge accounts can have big-time monthly returns. But this number 1 account that made 46% in June, they did have to endure a 30% drawdown at some point during the year. Markets are not consistent in one direction. They chop up and down. You need to understand that. As I go to year-to-date, you'll notice that 40% turns to an entire year 79%. Again, it's not predictable that you can make a fixed dollar amount or percentage every month. And the drawdowns still factor into this. And I'm going to talk about this in a lot more detail in a later portion of this training. But you have to go into this being realistic. Now, the cool thing about being a retail trader that I love is I don't have to deploy $100 million. I don't have to hold things overnight. I'm never worrying about how am I going to execute 50 contracts like a fund is going to have to worry about. It'd be very difficult to execute 50 contracts of any market except maybe S&P Mini without any issues or slippage. As a retail trader, 1, 2, 3 contracts, piece of cake. In and out, nobody even sees you. Very different story. So you've got a lot of great advantages. Like we always say, success is not where you enter. Do you know what's going to have most of the impact between success and failure? Your targets and stops, your risk management, your ability to handle the order management system. Trust me, that's huge. Speed of execution, eliminating mistakes. You're going to make a ton of them. Even to this day, on occasion, I hate to admit it, I do. Your ability to adhere to the trade plan, your ability to survive drawdowns, your ability to scale and downsides. This is the difference maker. It's not getting in at the right place. That's one element. It's one of the smallest elements. All these other factors will determine success and failure. They've already determined for all of you guys whether you're making money or not. I'm sure most of you would agree that, you know what, those are the things that have gotten me into trouble. That's why so much of our focus when we train surprises people. We get through the entry. I can get through the entry in our systems in 5 minutes or 10 minutes, honestly. Everything else is what takes the time. So the things to remember: don't trade like the crowd. Trade differently. If you're doing what everybody else is doing, if you're the sheep, and it's not going to work out for you, you're going to fall off the cliff. We do a lot of things very, very different at NetPicks and the PTU. Some of the things that I've told you today, you may even initially disagree with because it's not what you've seen and not what you've been taught. But the best traders can profit in all market conditions and not follow the herd and not follow the crowd. So what I want to do now is I want to go ahead and hand the presentation of Mike off to Mike. And let him kind of open your eyes to pretty amazing opportunities. And I'm going to let Mike do that. I'm not going to steal his thunder. So Mike, I just handed it off to you. So you're up.
All right, thank you, Mark. If you could just let me know, is my presentation showing on the screen?
Right now I see your workspace, your Windows workspace with the PDFs and all that sort of thing.
How about now?
Now I see it.
Perfect. Just had to switch over to the other screen. All right, so as Mark said, my name is Mike Rixey. I'm part of the faculty at Premier Trader University. And what I want to talk about today is the power of options trading. Before I get into it, everything that Mark just said is just, I can't stress how important that stuff is. When we start talking about risk management and identifying the best times of day to trade, using the correct chart setups, that's what's important. I can teach you guys a system, a successful system, in a very short amount of time. But if you don't have that other stuff mastered, you're never going to find the consistency that you're looking for. So definitely pay attention to what Mark just said. Go back and review it just to make sure you have some of those points covered in your trade plans. All right, so transitioning over to options. The title of my presentation, The Lost and Forgotten Opportunities in Stocks and Options Trading. From our poll earlier, I was really happy to see, honestly, 36% of you trading options. I know it doesn't seem like a big number, but that number has started to creep back up. For whatever reason, people just tend to forget about options. They've had bad experiences in the past. A lot of people just tend to lean towards the futures and the Forex markets. And those are great markets, don't get me wrong. But as you're going to see here today, there's a lot of great profit potential in the world of options. So let's go ahead and jump in. Let's talk about some of the reasons why I like trading options. Number one, the versatility. You can use options in so many different ways. I can use options to benefit from a bullish market, a bearish market, and a sideways moving market. There is no other product out there that you can say that about. For those of you that are trading futures and Forex, I would ask you, can you make profits in a sideways moving market? No, that's really what we all battle on a day trading basis. A sideways choppy market is our worst fear. But when you're trading stock and options, specifically options, there are definitely strategies that you can use that actually benefit from a sideways moving market. If you look at the overall equity markets so far this summer. Have we really made much ground up? I mean, really, if you take a look at the overview charts, we've just been chopping around. Okay, we've been in tight ranges. You know, they're pretty ugly looking charts. But when I talk to a lot of people that trade options, a lot of the traders that I communicate with on a regular basis, they're just making great money right now because it's perfect for some of the option strategies that are available. Next, the popularity. We just got done talking about how that percentage of traders is starting to creep back up, the traders that are looking at options, which I love. I love to see that. And it shows in some of the other numbers as well. I just looked at a statistic last night on Twitter. Somebody posted about volumes in July this year compared to last year, and volumes are pretty much up across the board in the options markets. If you compare that to what we've seen in some of the futures markets and some of the trading activity that we've seen in the Forex markets, we've really been all over the place. On some of the Forex or the futures markets that I trade, we've seen a lot of low volumes, seen a lot of chop. So I really think that over the next, I'm going to say, year or two, options are really going to explode. I think there's a lot of great profit potential there, so it's definitely worth your while to look into these products. Next, the leverage. Every product that we talked about here today, Forex, futures, and now options, they all offer great leverage for the retail trader. Okay, let's face it, most of us, compared to some of the big professional hedge funds, we have smaller account sizes. I know a lot of retail traders start in that 5,000 to 10,000 range. So we have to use products that give us that leverage. Okay, when we talk about options, I'm going to show you some strategies that you can use to control 100 shares of a $600 stock with as little as $1,000, $2,000. It really gives us, as a small guy, the opportunity to play with the big dogs. So that's really why I love to trade options. Next, the strategies can be used across so many different markets. With the strategies that we're going to talk about as part of PTU, you can use them on stocks, you can use them on ETFs, you can use them on index products. There's futures markets that have options available on them. There's so many different ways that you can use them. So if you take the time to learn some of the basic option strategies, you can use them across many different markets. It really opens up the door for so many opportunities. And lastly, they're a great product to diversify with. I've been trading for about 10 years now. I actually got my start trading options. But what I saw was, over time, my equity curve was all over the place. Yes, I made money, but along the way, I definitely had drawdowns. And I got frustrated during those times of drawdown because there wasn't anything else for me to do. Where I saw the consistent growth in my account really kick in is when I added the futures trading to the mix. So now all of a sudden, I'm day trading the futures markets while also having some swing trades on with options. And that's where I saw the consistency kick in, because I'm not going to say it never happens, but it's pretty rare that both types of trading hit a drawdown at the same time. For example, the last week and a half for me trading crude oil futures, it's been slower. Really just kind of spinning my wheels with the approach that I use. Now, in defense of crude oil, it just came off of an amazing stretch where we made a ton of money. So, and the slowdown was to be expected. But during that same week and a half where we've just been shopping around, my options trading has been amazing. I'm going to walk you through a recent trade that I just closed, the balance of the trade here this morning. Just some amazing profits, 100% returns in just a few days. So that's why I love the combination. I love the diversification. If we can mix in some day trading with some swing trading, I really think that's where you're going to see the success kick in. Okay, one of the complaints that I hear from a lot of retail traders is they shy away from options, number one, because they don't understand them. They just seem overly complex. If you're going to trade the futures or Forex markets, really all you need to be concerned with is buying or selling those futures contracts. However, in the options world, it's almost like learning a different language is what I hear from a lot of traders, because they try to jump in the deep end and they don't learn the basics first. I can tell you that there's a lot of basic option strategies that you can use that you can make great profits with. Okay. The second complaint that I hear is there's literally thousands of different products out there that have options available on them. How do you know which markets to trade? If you're trading the futures market, you really have only a handful of markets that are worthwhile trading. But when you look at stock and options, if you're looking at hundreds or even thousands of different stocks, it can be overwhelming. So how do you narrow that list down? Well, number one, I want to narrow the list down to a very small universe of stocks. I don't want to be concerned with stocks that have low volume, that have choppy price action. What I want to do is try to create a diversified list of stocks that cover different sectors. Okay, I don't want you, if you can only trade 2 to 3 names, if you're trading a smaller account size, I don't want you trading Apple, Google, and Amazon. They're way too correlated. I want you to try to avoid that. So what I'd rather see you do, cover some of the different sectors. I've listed some of the main sectors here that people track. We've got tech, energy, financial, index, retail, and commodity. Try to get a mix of those products. Okay, I don't want you to sit there and look at every sector and say, okay, I need 2 or 3 names inside of every sector. It's not necessary. Next, get a good mix of stocks and ETFs. I personally love trading individual equities. When I take a look at my overall performance, a lot of my home run trades are going to be on individual names. However, there's certain ETFs out there that also have great price action, very liquid options. I love trading those because they give me an easy way to diversify. For example, if I need a name inside of an energy sector, instead of going in and testing dozens of different names, I can go ahead and look at an energy sector or an energy ETF that covers the whole sector. It gives me an easy way to get that diversification. All right, so what are the tools to initially find those names? Well, there's a number of different scanning tools available on the internet. You can use different charting platforms depending on what tools you have available as part of your trading. I like to use TradeStation for my charting, and inside of TradeStation they have hot lists. And I have a picture of a hot list here a couple slides later. Basically what this list does, it's scanning, looking for the names with the most active options. Okay, so this is just taking a look at the overall volume of options traded. It's going to show me the most active names. Now, you can take a look at the top 50 if you want. I don't want you to trade 50 names. I don't even want you to look at 50 names. It's not necessary. You can go through this list and try to find a very small list of names that you can trade consistently. If I were to show you my actual watch list, my trade list that I look at every day, you're going to find every one of those names on a scan like this, looking at the most actively traded options. So a very powerful tool for those of you that do have access to TradeStation, just an easy way to identify the best trading candidates. And like I mentioned, you don't want to trade too many names. I'm going to talk here in a bit about my daily routine. The only way that I can keep this simple is by looking at a small universe of names. I want to know those names inside and out. I don't want to overcomplicate things. All right, here's a sample watch list that I put together. Now, I'm not saying these are the most profitable names or the best names. It's a list that's it's pretty diversified. We've got a lot of good mix here of individual equities, ETFs, different sectors. This is a great place to start. I've seen a lot of great results. A number of these names, we're seeing winning percentages in the 65 on up to 80% rate going back to the first of the year. Okay, so a lot of great performance. We have names like Apple, Priceline, some index products like SPY, which is an ETF that tracks the S&P 500. We have IWM, ETF that's tracking the Russell. We have Amazon, you have the Silver ETF, JP Morgan, and XLE, which is an energy ETF. So it's a good starting place. If you're looking for names to trade, use this as a starting point. Pull them up, start to track them. I think you're going to be pretty impressed with the types of movement back and forth that we see on these names. Okay, so once you have a shortened list of names that you want to look into, you want to do some testing. Okay, the list that I just gave you, I don't want you guys to take that and start trading some of those names, right out of the box. You have to do some initial testing. What I'm looking for here is, depending on the system that you're using, in my case I'm using the PTU systems, I want to go back in time. I want to find stats like my winning percentage, what's my average losing streak, do I have losing streaks in some of these names, can I expect 3 to 4 losers in a row? It's very important to know that. What's my overall profit? My average holding time. Average holding time for options traders is huge. It really helps in picking the specific options that you're going to trade. And then finally, money management methods. You want to get a feel for how this stock moves. On Apple, for example, not uncommon to see a $20 move in just a couple of days on Apple. Well, that's really important to know when you start to manage the trade, based on the profile that you're looking to go for, how does that stack up to how Apple moves historically? It's really important to pay attention to that in your testing. So number one, you want to make sure you're documenting the trades so that you can gather the stats. And then once you have some of that testing done, you're going to want to go in and create a trade plan based off the test results. Any type of decision that I make, whether it be managing a trade or placing a trade altogether, I have to back up that decision based on stats. Okay, if I can't back up my decision based on stats, then it's probably not a decision I should be making. Okay, this slide right here, this is what gets me most excited about trading options. This is just a glimpse of my daily routine. The power here is that it doesn't take much time to do this. Okay, when Mark was talking about trading small windows of time and trading no more than an hour or two on a day trading basis, well, I can show you a way to trade options where you're coming in literally less than 10 minutes a day. Okay, a lot of times there's nothing to do when we come in. We're not actively trading. We're looking for swing trades. We're looking for the very best moves. So we're really just taking, what Mark talked about with the day trading, and we're just simplifying it. So the way I start out my day, I like to come in before the open. Okay, could you come in after the close the day before? You could. There's so much that can go on overnight. I really like to come in before the market opens at 9:30. What I do when I come in, I want to scan each chart, start to take some notes. Do I have any new setups? If I'm in any new setups, do I need to adjust targets or stops? Do I need to set any price alerts for myself? Document all that so I can go into the session with a plan of attack. Once I have that done, I may stick around right after the open if I have some trades that I want to initiate, or if I need to make any adjustments. I can come in for a few minutes right after the open, and then I'm just periodically checking in throughout the day. Okay, I list here coming in at lunch or sometime in the afternoon before the close. When I do this, literally it's a 30 to 60 second look at the charts. Okay, just to make sure, okay, am I approaching any key levels? Am I approaching a target or a stop? I can do this very quickly. Not looking at sitting down for an hour to look over all my charts in detail. It's just not necessary. A big part in the morning is setting those price alerts. The price alerts are what allow me to break away from the computer, move on with my day, or just to do some of the day trading on a different screen. So what I do is I like to set those price alerts either in my broker platform or in a mobile platform on your cell phone. So a lot of brokers offer those mobile platforms. So once your price levels are hit, if you're approaching a target, you set a price level for yourself. If I get that alert sent to me, I know I got to get in. I got to check that trade. Okay, getting away from the screen throughout the day, that's what prevents us from over trading and over managing the trades. What I find is if I sit down for an extended period of time and I'm looking at the charts, I might start to see things that aren't necessarily there. If I'm in a trade and I'm starting to approach a target, price action starting to slow down, we're starting to pull back a little bit, my emotions are going to take over and say, maybe I should get out of that trade. I want to protect as much profit as I can, instead of letting the system work for me. Okay, letting the system play out according to my trade plan. So getting away from the screen, letting those trades work out, it's a great way to just really simplify things. Okay, so let me bring up a chart of Apple, because I want to walk through this trade that I just closed out here this morning. Okay, this is one of the PTU systems that you heard Mark talking about here earlier. The power of the PTU systems, it does a lot of the hard lifting for us. Okay, if I'm looking at Apple here, the PTU systems give me my entry point, my targets, and my stop. Okay, all that's done for me. So that leaves me to focus on the specific strategy that I'm going to use to play this setup. Now, could you buy the shares of stock here and just play it using the stock? Absolutely. Not a problem doing that. The only problem I have with that is it does tie up a lot of capital. So for those of you with a smaller account size, can you put on a sizable position on a $600 stock like Apple? Probably not. So what I'm going to show you is a way to use the options. You can go ahead and purchase a call option to control 100 shares of Apple stock for as little as $1,000, $2,000. That leverage there is incredible. So this is a setup. It triggered in on the 30th, so it triggered in on Monday. Very straightforward long setup. Okay, we had plenty of time to get our order in. System gave me an entry point, 596.33. Okay, it was a little awkward initially. I didn't really like getting in right in front of that 600 level, but I didn't want to make a $4 adjustment either. So I went ahead and just went with that setup at 596.33. My first target here, that was at 606.55. My second target was at 613.19. Now typically on Apple, my average holding time is anywhere from 3 to 5 days. Here lately, these trades have been moving very quickly. A lot of times hitting target in 24 to 48 hours. And this is a perfect example of that because we triggered in Monday. Instead of buying the shares of stock, I went ahead and I purchased the August 590 call. I bought that for $12.55. So my total cost on there was right around $1,255. You can tack on a little bit there for commission. What that did is it gave me a control of 100 shares of Apple stock at $590 per share. In this case, I knew where my targets were at. I came in yesterday. We actually hit the first target yesterday. I like to trade multiple contracts. It allows me to scale out of the position as I go into profit. So in this case, I sold my first position, half of my position. I sold it for $23.70. Okay, gave me over $1,100 of profit, and that's basically overnight. Okay, really nice move on Apple. So just taking a look at that half position there, pretty nice return. Showing you a market that you can go ahead and do that on in 24 hours or less with $1,200 of capital committed. Okay, what I did is I came in this morning, I carried half of my position on, trying to go for that extended target. And we came in this morning, hit it pretty quickly, sold out the remainder portion of the position. Okay, and that is actually a mistake because I sold it out for $28. Okay, so another really nice profit over on Apple. On a two-position approach, I'm looking at total profit of $2,600. So for two contracts, I'm basically, I'm committing $2,500 worth of capital, and to see a $2,600 return in essentially 48 hours, that's just incredible. And here's where it gets fun. My total amount of time committed to this trade, placing it and managing it, less than 15 minutes. Okay, kind of work those numbers in your head. What kind of hourly rate is that? I mean, that's just an amazing return. And some of you might be saying, well, yeah, it's a great trade. That's you just kind of picked a nice winner there. Well, I can tell you that Apple, going back to the beginning of the year, we're seeing over a 70% win rate. That watch list that I gave you guys earlier, on a lot of those names, we're seeing win rates in between 65 and 80%. When you're seeing that type of win rate combined with these types of percentage returns, this is where it gets fun to trade. Okay, so I don't care whether you're trading futures or Forex currently, you might be totally new to trading. You really you can't ignore these types of numbers. You have to be able to consider branching out, maybe looking into something that you don't really know much about at this point. I can show you how to trade options very easily. All right, so that's just it's a perfect example. It just closed out this trade this morning, so I just really wanted to show it to you. It was just an exciting trade for me, and we see those trades all the time, so I love it. All right, so part of the PTU program, which Mark is going to talk about more here in a bit, some of you might be saying, okay, yeah, that looks exciting. I don't really understand a lot of what you said there, call options and put options. What we do with the PTU system is part of the university. We offer different types of specialized training, and it's basically, we call them a major program, similar to what you do in college. And inside of this options major, we're going to break it down into great detail. Everything that I talked about today, it's going to be talked about in great detail. We'll talk about setting up a watch list. We'll talk about what to look for when you do your testing. The trade on Apple that I just showed you, I'll give you 14 to 16 names of different stocks that were seeing those types of results on a consistent basis. Now that call option that I just talked about on Apple, how did I know to pick that specific option? Well, I'll walk you through step by step the criteria that we look for that really helps pinpoint which option to play. And then I know I had to move very quickly through that trade example, but we'll just, in the training, we'll go through example after example to really pound those points home, really, so you can take the system, be comfortable with it, and really run and see those types of results for yourself. All right, so hopefully that helped give you a preview of options. Hopefully I've kind of piqued your interest there. I really hope to see a number of you in the next round of training. I look forward to working with many of you. So at this point, Mark, that is all I have. I will throw it back over to you.
Great. Thank you, Mike. Really appreciate that. Great presentation as always. Really fascinating stuff. I wrote down a couple notes as you were going through that. And one of the things that I wrote down was when you showed that Apple trade with the calls, you were controlling 100 shares of basically movement. You're kind of renting that stock. Well, that's $60,000 of value of that stock for, I think it was about $1,255. So again, people always think, oh, stocks, there's not enough leverage. I'm going to need 60 grand to trade 100 shares. So you're showing us literally how to have 47-to-1 leverage, how to have a completely controlled risk because we know exactly what our max loss is going to be, and certainly it's nowhere near, right, 60,000. It's just the contract value. And in that case, really, I think in a lot of ways, turns the stock and ETF opportunity to be just as good as a leveraged opportunity as futures, and certainly just as good as Forex. And I think that's why a lot of times people feel that it's not, because they make the assumption you need just a massive amount of capital to be able to control, obviously that size position. So really cool stuff, really exciting stuff. It's why we wanted to present it to a lot of people, because I know about 30-40% of you are doing some stock and options, but a lot of people have just seen most of the marketing in the industry over the last few years, and a lot of it has been about the Forex opportunity. And it's not to say that there's not opportunity there, but I'm hoping that we open some people's eyes to really where other opportunities are. So the third topic I wanted to present today was, I think, really critical, and that's treating trading as a business. And so I want to give you a little presentation here on this. There's some really neat things in here. I do have to give credit. One of my coaches, Will Feibel, really put this together, and he was nice enough to let me obviously present this information, because when we've presented this in our trainings, it's been really eye-opening for a lot of people. So again, thanks to Will, but I think you guys are going to really get some good stuff out of this. So some of the first things you have to do is you need to decide, what can I trade? I'm sure most of you, as we present to you a lot of opportunities here in a lot of markets and futures, we've talked about Forex, and Mike's just talked about this amazing world of stocks and options. You have to start to make some decisions on what you can trade. And one of the first things you need to take into account, of course, is the size of the risk and reward. You also have to take into account the winning streaks, and yes, this is about honesty here and full disclosure, the losing streaks. You also need to understand how much money, capital, margin, depending upon what you're trading, is required. What account size based upon what you personally can tolerate. One guy may be very comfortable with a drawdown of 10% or even 20%. I could talk to somebody else who literally panics at 5%, and somebody else who doesn't even blink at 40%. Not that that's necessarily good, but there's huge variance in everybody's individual trading personality. So one of the things you have to always do is understand the risk on every trade. You have to look at history. Yes, history does repeat itself in trading. It doesn't repeat itself perfectly. You can't expect to do exactly what happened in the past is going to mirror itself in the future, but there's nothing better to kind of tell you what could potentially go wrong on the risk side and what you should plan for going forward than looking at historicals. And one of the key numbers that we tell you to look at is the average loss per trade. Now again, I want to stop for one moment and realize that here I am as a trading university, a system developer, somebody who markets in this business, and I am talking about, oh my God, losses. Because again, we are trying to treat this as a profession, be upfront with you, and if you want to succeed, we can't just talk about everything good that can happen in trading. Trading is amazing, The opportunities are incredible, but you have to be balanced and you really have to look at both sides of it. And that also includes what's the maximum loss. Because again, if you will learn our systems, go through the training, and you understand the risk, you're going to make it. If I don't get you convinced on this part, you're not, despite the fact that training was awesome, despite the fact that the system is great, despite the fact like you can have trades like Mike showed you. Unfortunately, if you don't acknowledge this part of it, I can't get you to the point where you're making money. Statistical deviations, the head starts to spin a little bit, but again, all it is just understanding that there's variance, right, based upon averages. There's outliers, okay, based upon averages. So this is an important chart to understand what's going on here. And some of you have seen this before from us. If you haven't, I really want to point out a few things. And really the heart and soul of most good strategies is this win ratio. It's just not realistic to expect 80% or higher. I know there's systems out there that build themselves that way, and over some length of time, they may achieve 80%, 90%. It's never over a real length of time. It just doesn't happen. I can go into all the math why it won't hold up, but I have found over the years, and we've been doing this a long time, this is the bread and butter. That's 65 to 70%. Psychologically, it works for most people, and also the numbers work for most people. Now, what this is telling you, though, is that you have a 100% chance of losing 3 times in a row on a losing streak. Not every time you take trades, but, you know, things don't always go your way. Markets are not always generous. You have a 10% chance of losing 5 to 7 times in a row. So, granted, that's a pretty small probability. And you know what? With PTU, a lot of our losses are partial. So it may not be 5 to 7 full losses in a row, but strictly mechanical, mathematical, we should prepare for this. Even the 1% probability, very unlikely, 7 to 9. Don't you think if you prepared yourself and set your account up to the right size for this, that when you lost 1, 2, 3 times in a row, you'd be like, no big deal, because you know what? I'm prepared for this, and my normal little losing streak when things are going bad is 3, yet I'm prepared for 3 times that. This is one of the secrets to succeeding in trading. You will make it if you account for this and you make yourself comfortable for this and you have the account size that can handle this. It's so huge. And we can go down, you can see on lower winning percentages, the streaks that you have. There are strategies out there that win 40% of the time and do amazing. What I have a problem with is I haven't been able to get a lot of people psychologically to handle maybe losing a bunch of times in a row to eventually get that big winner. So that's why I found the 65 to 70% seems to be really kind of the golden level. Now, wins and losses come in clusters. There's the dream time, where it just seems like, every trade's working great. You may have a bunch of winners, but you know what? They get mixed. Winners, losers, and I found that it really tends to cycle. Mike brought it up, like on one market, crude oil, where it was so generous, so easy. It goes through those stretches, but you have to know as a trader, if that happens, it's going to be a little bit more challenging for a few days, a week, whatever the case, 2 weeks, and then it's going to get easier again. This is how things cycle, because sometimes they get ridiculously hot. Like, on here, the euphoria. Hey, I can't miss. Every trade's green. I'm a genius. This is the holy grail. Forget what Mark said before. This is the holy grail. And then this happens, right? And you go on a bender, a losing trade bender, and the world is coming to an end, in your opinion. It will come to an end if you don't prepare for this potential eventuality. It should not almost ever look like this, but you know what? If you're prepared for the worst case, how much more calm will you be when you have a loser or 2 losers? No big deal. A lot of people present to you and say, look at the equity curve. They don't even show you that. All they show you is this. 45 grand. Love it. What they don't show you is the ride, the a little bit of an adventure that you have to go on. It can't always be hot. It's not always easy. Sometimes it's easy. Sometimes it's not. But you know what? Every single time with our systems and strategies I found where it gets difficult, it always gets hot. It always gets hot. And I fully expect to be hitting new equity highs all along the process. But it's not all about the final number. Get that out of your head as much as you can. You'll get there. But you have to realize it's made up of clusters of winners and losers. Now, how do you calculate drawdowns? All you have to do is take the loss per trade times the length of a losing streak. Here's some examples. If you had a 65% win rate, we've already told you there's a 100% chance of losing 3 times in a row, correct? So we just prepare. $200 I lose per trade. I'm going to lose 3 times. 600 in the bag, going to happen. 10% chance I could lose up to 7 times in a row. Now again, we're not going to lose max loss, but prepare for it. Why not prepare for the trading world coming to an end? My drawdown could be this if I lost literally 7 times in a row, full loss. 1% probability says 9. What if I prepared for that 1% probability? That's what you should do. That's the smartest thing to do. The most aggressive trader is going to do this. Well, probably not. You're not going to prepare for any losses. You're going to use the 50-to-1 leverage the broker gives you and not prepare for any loss. But if you do this and prepare for the max loss, you're going to be better than 9 out of 10 traders, I guarantee you. Don't underfund your brokerage account. Psychologically alone, if you don't underfund, you're going to stay with it. You're going to stick with it. Now, there are margin requirements that brokers also have. Okay, they're going to have different margin in futures, for example. They're going to say if you day trade, we want you to have at least this much in your account. If you hold overnight, they're going to require you to hold more money. They're also going to have what's called a minimum account margin. The good news is, you see all these? Really, if you follow our formulas, none of them matter because I will always have more than what the broker requires. I will always have more in my account per contract than the overnight initial, and certainly more than the overnight maintenance, and definitely more than the day trading margins. And you can find smaller day trading margins than these. This is from a very conservative broker, Interactive Brokers. I've seen lower than this. But you don't need to trade this way. You don't want to trade an S&P Mini with $1,750. Could you? Yes. The problem is your drawdown percentages are going to be way too high. You may not make it. You're going to have margin calls the moment you start trading. That's no fun. Now, if you do the initial overnight, you know what? You may actually never have a margin call. If things go pretty good for you, this may literally be all you need. I told you $5,000 before, remember? And here I am showing you that the brokers are saying, sorry, that's horrible writing. That's how my writing is in real life, by the way. Much, much lower than 5K. But we want you to have enough to be able to endure the good stuff and the bad stuff, treating this as a business, right? If you have a business, not every day do you make great sales. The same with trading. So why does margin matter? You cannot trade without sufficient margin. Your account has to be large enough to maintain margin equity after drawdowns. So here's some examples. Crude oil, that's CL by the way, crude oil futures. The broker has said you need $7,000 initially in your account to start executing those trades. Now they'll require you, you only have to have a fraction of that once you execute the initial trade. Again, remember we said 100% probability, 10%, 1%. So initial margin $7,000, we're already looking at this formula and saying, you know what, I need a little bit more. I want to be able to endure these 9 losses in a row, worst possible case, and still be in business. You know what, if I drew down $1,800, I would just be back to my initial margin requirement, no margin call. I understand if I got to a 10th loss, we may have to put a little bit of money into the account, but that's 10 losses in a row that we have prepped for, and it's not that much more capital overall. Again, you do just this, and you're going to be so much better than almost every other trader out there. Now, the reason that we show you this is there's a second factor that factors into this. The drawdown percentages that I showed you, if you lost a bunch of times in a row, they can be getting up there. They can get into the 20-25% range. What you have to understand is if you draw down 25%, if you make 25%, you're not back to even. You need to make 33% to get back to even. What I find on Forex traders a lot is they're really treating it like a casino and a gamble, and they're comfortable drawing down 50% because you use all that leverage the broker gave you, because if you do, you know what, you can double your account overnight. It happens. It happens all the time in Forex when people first start out. Every single one of those same people wipe themselves out soon thereafter. Because the second you start to draw down 50% just to get back to even, you need to 100% gain. That starts to get really challenging. I'm here to tell you the only way you come back 100%, 150% is you start using huge risk and leverage. And you know where that leads to? off this chart, and it means your account is gone. You're going to the bank to wire some more money in. You know you've done it, some of you, and this is why we really also want to focus on drawdown. Okay, not just the margin required and not just the additional money we want you to have in your account. We want you to understand that drawdown percentages do matter. And you know, markets change. You know, Mike mentioned it. Markets go through cycles. Clusters come in clusters. It's just the way it is. We can't control it. There's Murphy's Law. Things go wrong. A platform goes down. Your internet goes down. Some flaw happens. You can't be flawless in what you do. It's really important. A lot of you identified this 1 out of 5 saying psychology. It's huge. If you do not have enough money in the account, you're going to have problems and you're going to start to break all of your rules because you're going to panic. And then there's lifestyle needs. You know, I'm going to show you here at the end of this part of the presentation a way that you can start to calculate where you can start taking money out of your account, growing your account, and actually taking an income. Because I'm not a believer in leaving all your money in your broker for a lot of reasons, some of the reasons that you've seen in the news. So we do want to turn this into something where we're able to draw capital out of that account every month, but you can't do it too soon. You know, lifestyle needs, just to expand on that, region of the world, time zone of the world, your job, your commitments, your risk aversion, all these things, again, factor in beyond which account or which market and which margin or which, I should say, market you end up trading. So enough about all this number stuff. Let's talk about trading. So how big of an account do I need? This is the way you should do it. Make sure you have enough to cover the margin plus that worst case drawdown. In addition, you want to have a short recovery from drawdown. So how do you do that part? How do you make this psychologically acceptable? If you control your risk to that 2%, you're going to come back. If you lost 9 times in a row and you set up your account the way I showed you and you risk 2%, you know how big your drawdown would be? You guys know. 18%, it's not that big. I can tell you every leading mutual fund that's out there that in their best year makes 10 or 15% has drawn down 18%. So these are big funds trading stocks with no leverage, all buy and hold. Even they draw down that percentage. So, you know, here's a situation where worst case with a hell of a lot more leverage than they use and a lot more percentage, you know, possible return, and you can control that leverage or that drawdown with very minimal risk, you know, just the 2%, or even if it's down to 1%, you can have a single-digit drawdown. Now, the question is, can you go higher? Yes. I mean, I realize that it's going to be tough for some people to risk 1% with $5,000. You're going to be limited by the markets you can choose from. It's doable, but you're kind of boxed in a little bit. So I realize in the beginning some people are going to have to go for that 3% risk. Just realize you've put yourself in a little bit more of a situation where in the worst possible outcome, you know, you're going to be worse off, right? It's just the way, if you lose 9 times in a row, that's 27% versus 18. Just prepare for that. Know that's a possibility. Make sure you have enough margin to cover that. So minimum account size, the best bet is to do the greater of the margin plus the drawdown or the risk per trade that you'll know on your trade plan divided by the maximum risk percentage. So if you took $200 and you knew that you wanted to risk 2% maximum, that's going to be $10,000. Well, you might do the first calculation, margin plus drawdown, and it might tell you only need $6,000. The smartest, the best, the safest, the calmest is going to be using the greater of either one. That's the safest formula overall. So here's a quick example. Russell Lee Mini, let's just say the maximum risk was $300. We have plans where it's half that, but I'm going to go for the more, you know, the bigger plan. So the margin required isn't much, $37.50, you know, 1% potential drawdown risk of all those trades in a row, 9 in a row. So you would need $64.50 to cover the drawdown worst case and the margin. And you can definitely start there. Now, if you wanted to risk just 2% and you wanted to risk up to $300 in the max, not the average, that's $15,000. So we know between $64.50 and $15,000 is kind of where we should be. The most conservative of all, and the safest is always going to be the 15. By far the most aggressive is going to be $64.50. But once again, even if you came in at $64.50, I'm here to tell you, you're going to be smarter than 9 out of 10 traders who start, because almost everybody starts at $37.50. So you're so much smarter just using the probably maybe the minimum of this formula. And anywhere in between from 64.50 to 15, you're going to be so much better off. And you know what? If that's too rich for your blood, as they say, focus then on a trade plan that does not have risk maximum of $300. What if you focused on a plan that we have that is $150 or $200? Now that $15,000 in the most conservative of setups can become $7,500. Okay, it could become half of that. Should you go down to $3,200 here? No, of course not. But all of a sudden, you can see how you can trade at that $5,000 level, that $6,000 level. So if it's too high, just use smaller risk profile trade plans. You can literally cut this in half. So what we put together here for you was a single contract. On this chart is U.S. equity and some interest rate futures using some of the active trader plans. Well, these are actually from our active swing trader, so bigger profile. Okay, so you can see the ranges. Remember, 15,000 at 2% risk, 1% risk, 30,000 per contract, and you can see the range here, as low as 7,000, as high as 15. If you went to 3% risk, well, you can cut all these numbers in half, but your risk is going to be higher. Your profile is going to be higher. What I would suggest you do, if these are just too high for you in a 2% max risk, focus on some of our other trade plans that we call active trader. Instead of active swing trader, we have plans called active trader that literally go for targets that are about half the size and stops that are half the size. So all of a sudden, my S&P Mini becomes very manageable, right? Could be close to 5,000, or my Russell E Mini 7,500, or my NASDAQ under 5,000 even. But I still suggest you have the 5 minimum. You can see the treasuries here, the 30-year bond and the 10-year. So again, there's always a way to find something that's going to work for you. Crude oil, with the big plan that we have, you're going to need, if the 2% risk, to understand up to 15,000. Now, if you're willing to have a larger drawdown, possibly worst case scenario, absolutely you can have less. If you're willing to have that 3% risk, again, you can cut that in half. But we're trying to get you guys to sort of be thinking about having the best possible chance of long-term success. Foreign exchange, it works the same way. If you had 21 pips on average loss and you wanted to get all the way down to 2% risk, $2,800 for a mini. That would count for everything. 9 losses in a row, 2% max risk, less than 20% drawdown. You'd be golden. You might be thinking, wait a minute. I mean, my broker will let me trade a mini for $1,000 or even for $100. That's all fine. Your broker lets you do what they want to do, but it's not smart trading. Can you do for less than $2,800? Absolutely. Just have to realize you're going to be tweaking the numbers. You're going to have to accept a little higher max risk, or you're just going to have to assume, that 1% chance of 9 in a row, it's so unlikely to happen. And, it clearly is. I mean, let's be honest. It's very unlikely that that's going to be the first thing that can happen to you. So you could take a little bit more and get more aggressive and say, I'm going to focus on the 10% max, which is the 5 or 6 in a row. And these numbers would literally get chopped in half. But again, I'm always a believer, as much as you can capitalize. As close as you can get to this ideal number, get to it. Even if you come up short, but you're close or within range and you factor this in, again, you're going to blow away most traders. You're going to know so much more than most people who start to trade. And it's same with the Euro stocks, the DAX futures, the Euro bond, the Euro bobble. That's all things you see here. Some of the ranges overall based upon these best ideal situations. And then you just tweak the numbers based upon what you can afford, what you're personally willing to risk. All of us are a little bit different. We have sort of, different things we can handle. So trading as a business, this is what, kind of what I call playtime, because it gets really fun when you treat it this way. You determine what you're going to trade. Then you actually start to treat this like a real P&L. And you see how you can actually make money and start to take money out and, go past your initial funding and plan for capital. This is the fun stuff. And let me show you something. I'm going to go to a spreadsheet. Hopefully this comes up on your screen. And this is when we like to have a lot of fun, because let's just say my starting capital was $20,000. Let's even drop it down. We'll say $15,000. And I realize some of you that'll be $5,000. Some of you in Forex it'll be even smaller. But it doesn't matter. The point is to kind of demonstrate something here. And let's say we've looked at the historicals and we've found out that the average contract, all wins and losses, is $75. Meaning, who knows? Maybe on a winner it makes $300, but on the loser it loses $300, and you've got a certain percentage that win or lose. The average is $75. I mean, very, very, actually quite a bit lower than some of the plans that are double this. But just trying to show you how powerful this can be. Let's say you also realize, in the market you're trading, there's going to be a maximum number of contracts you can trade before maybe slippage and execution and things the big guys have to deal with. Now, I mean, 10 contracts on most markets shouldn't be a big deal. And you already, again, look at the history or the trade plan, and you know that the max risk on that one is $225. You've already said, you know what, I'm going to risk no more than 2%. Now, these additional numbers here are some requirements that basically what we say is we'd like to start withdrawing money starting at $1,000 a month and eventually get to $10,000 a month to, let's say, replace our income. And your numbers will be different. Everybody's got different requirements. The other things here are we don't want it to quickly pull money out. So what I'm saying here is, you know what, don't pull money out until I get to, let's say, $25,000, because I don't want to immediately start to pull money out, and then this is like a benchmark that I have to get another 10,000, another 10,000 before I start to amp up the money. But what's fun about this, you can change all this, but you can see, you have expenses in this business. There's charting and brokerage fees. There might be data fees. You might have some kind of web subscriptions that you use, internet service, and supply. So, in a given month, what we're saying here is maybe we have $575 in expenses in our business. And if we traded one contract, we ended up with $1,500 based upon this win rate and some averages that we use per day. And I end up with $925 in profit that month, okay? Very, very conservative, right? Now notice how the number of contracts that I trade stays the same, stays the same, stays the same, and then all of a sudden it starts to ramp up to 2 contracts because it's waiting for me, in this case, to have enough capital to keep that risk at 2%. If I change that to 3%, you notice how quickly the contracts go to 2. Literally the second full month, I jump up to 2 contracts because I now have enough money in my account to be able to handle that. Now, if I go to 2.5%, maybe somewhere in between. By 6 months in or 5 months in, I'm starting to double, then triple, then quadruple what I'm doing. Look at my trading income. It starts off nice and slow and steady, and then what happens? It starts to really take off because my expenses don't grow, right? Your expenses don't grow. So I start to get a real multiple here that kicks in, and by the time I'm up what I required, which is $25,000 in August, the 8th month in, I'm starting to take money out of my account. $2,000, $3,000, $4,000, $5,000, $6,000. So as the months grow, we're patient with this. We're not trying to get rich quick on the first month, January 1st, or let's call it August 1st here. We're not looking to get rich quick, but look at how much this grows if you'll just give it the time. And this is clearly conservative. This is crazy numbers. This is a good starting account. It's modest risk. It's modest everything. And ultimately trading income over the 4-year stretch here, 661.5, capital that you now have in your account, the income that you've taken out. Taking a look at the equity curve, what you're looking at here is the stair step is actually the contracts that you're trading. And literally by the 2nd year, we're at the max, and we keep it at 10 for a variety of reasons. Your capital just continues to grow, and all the while your account is growing, you are taking money out of this account. All right, that is where the power of compounding and trading really kicks in. It doesn't kick in on the first few months. It just doesn't. You have to let yourself grow as the account gets bigger. We can go down to 1% risk, and will the account grow over time? It will, but you know what? We're probably going to have to, at 225 risk, maybe we have to focus on a plan that has some smaller, average, risk overall. And you can see here, we pretty quickly get up to this number of contracts, but I never get too much further. So what's the reason for that? Well, the reason for that is because my starting capital, and I'm risking so little in this case, this may not be the perfect approach. That's why I say in the beginning, I may need to risk a little bit more. I may need to find a plan that has a little bit higher average, per contract. I might need to limit when I take my money out. Maybe I need to kind of, bring this up a little bit further. But all these numbers can be tweaked, and the same result happens. Over time, you will amp up. At the same time, I can't pick something that's going to average too little. $15 per trade, I'm really never going to be able to grow my account. It's just not going to happen. I have too many costs that are going to wipe that out. So it's not all about the, the upside, the golden side. You have to account for everything. This is all what we get into when we're determining what to trade, what markets to trade, time of day, day trading, swing trading, futures, forex, options, and we're turning this into a business. We're trying to get out of the mindset that this isn't a business, that this is gambling, that this is just kind of seat of the pants. It's not at all. This is serious, serious stuff.